In this video, not only will I be going through how to read a balance sheet, I'll also be going through the importance of a balance sheet for you as an investor. First things first. Imagine balance sheets as a snapshot of a company's financial position. Through this snapshot, you can see the value of a company's assets, its liabilities, and the shareholder's equity. Now, it doesn't matter who owns it. If the company controls it, an asset is anything that brings value to the company. Think of the computers they have, the products in their inventory, and also think of the money they have yet to receive. That's an asset as well. On the other hand, a liability is a debt the company owes to someone else, maybe another company or a financial institution. Think of credit card loans, long-term debts, and also the money they have to pay to their supplier. Meanwhile, shareholders' equity tells you the value and thus the proportion of business assets you own. Think of it this way. If the company decides to close operations and liquidate their assets, after they pay all their liabilities, that's the money shareholders have. So maybe that's why companies with higher proportion of shareholder equity is more appealing. The number one rule, balance sheet, is thankfully in the name, that it must balance. Balance sheets will forever follow this simple formula that total assets are equal to the sum of total liabilities and shareholders' equity. Second thing second. Current assets are regarded as assets a company has that can be liquidated to cash within one operating cycle. Basically, it can be liquidated to cash very quickly. Why is it important? Well, companies fund their daily operations through current assets. If there's not enough current assets, they're going to have to look for money, which will result to 1. A dilution of shares through more stocks being issued, or 2. Through funding, which means they've got to pay back interest. Basically, an insufficient current asset is bad news for you as a shareholder. As you can see, current assets for Facebook can be anything from accounts receivable, short-term investments, to inventories and other stuff. Look at the bottom to find total current assets. So guess what non-current assets are? You've guessed it. They're basically assets that will take longer than one operation cycle to liquidate it. That's if they intend to liquidate it. Property, land, long-term investments are all non-current assets. These are the non-current assets Facebook have, and they range from properties, intangible assets, and long-term notes receivable. Remember, total assets is the sum of current and non-current assets. Third thing third. Current liabilities are what a company owes to its creditors and suppliers. It's the bill they have to pay. There are quite a few categories of current liabilities. One of them is account payable. Like mentioned earlier, this is the money a company owes to whoever. Short-term notes and long-term debt are also current liabilities. Why? Well, short-term notes is the value of credit a company has taken from a financial institution, whilst the long-term debts refer to what is due in the present year. There's also accrued expenses and income tax payable. On the other side, non-current liabilities look at the longer-term obligations, such as loans and long-term payables. Remember, total liabilities like total assets are shown at the bottom. Let's take a look at shareholders' equity. Now, notice how the total liability and shareholders' equity is equal to total assets. This follows the very basic rule, rule number 1. That's all there is to reading a balance statement. It's that simple. This is Zahid. This is Susanna. Thank you.